All right. Well, I imagine we might have some more people joining after we get started, but let's go ahead and kick this off so we have the most time possible with our speaker today. So welcome everyone to the Insights on Agricultural Land Access and Stewardship series hosted by the Agricultural Land Equity Initiative at the California Strategic Growth Council. This is the third in our speaker series. We're very excited to have you join us today. Before we turn it over to our speaker, I wanted to let you all know about the California Agricultural Land Equity Task Force. Our team at the Strategic Growth Council facilitates this task force in producing a report of recommendations for the governor and the legislature by this coming January 1, 2026, about how to equitably increase access to land in California for food production, fiber production, traditional tribal agricultural uses. So this series is meant to take up issues that the task force has elevated as of interest, and to make a public space for people to learn about those issues and for task force members to learn and continue to move their work forward. So we're excited to have you all today for a presentation by Dr. Madeleine Fairbairn, who is Associate Professor in the Environmental Studies Department at UC Santa Cruz. Madeleine has done a lot of very important research in the areas that the task force is considering. So we're really excited to learn from her today. She's going to discuss how farmland is being transformed into a new financial asset class and why we all should care. So with that, I will please pass it along to Dr. Fairbairn.
Thank you. Let me share my screen. All right. Okay, so thank you so much for having me. I came to the task force meeting in Salinas and I was so inspired by the work that you all are doing. I came back and told my students all about it and stuff. I just think it's wonderful. So I'm happy to be a part of it in any way. All right. I'm going to start here. Bill Gates, always a good place to start. Back in 2021, Land Report magazine surprised a lot of people by reporting that Bill Gates had become the #1 largest landowner in the US, largest individual landowner, with 270,000 acres to his name. And a lot of really breathless reporting and commentary followed. You can see some of the articles here, some of the headlines. And because it's Bill Gates and he's a controversial figure, everyone was trying to figure out some kind of, nefarious or philanthropic motive for him. Was he doing this to feed the world or, fix climate change? But the result seems to, the real answer seems to have been much more mundane, that this was just a decision made by his asset management company, basically, that this was a good use of his wealth. And this is a decision that's been made by a lot of large investors recently, particularly in the years following the 2008 financial crisis. We see many institutional investors, including pension funds, hedge funds, university endowments, moving capital into farmland. So for instance, maybe the most famous one is the giant pension fund TIAA, which began aggressively buying farmland only in the year 2007 and now owns about 794, you can see it over here, 794,000 acres in the US, and over 3 million acres globally, worth almost $14 billion. And so this is just a really rapid expansion in farmland ownership on the part of TIAA. And in a quote, a TIAA executive kind of captured the way that the company is thinking about this. He said, this was a Reuters interview, "This is just another asset class that has the potential of going the route that real estate, private equity, hedge funds did in the past." So these are all sort of alternative asset classes that have now really gone mainstream. And so this phenomenon is what I want to talk about today. We see this trend, many people refer to it as an assetization of farmland, where farmland, here's a figure from The Economist, farmland is increasingly placed alongside other asset classes, such as stocks, such as bonds, such as gold, and seen as just another viable place to put your investment capital. Scholars studying this trend have been really quick to point out connections to the broader political economic context in which we find ourselves. For instance, many people, myself included, have referred to this as a financialization of farmland. This term, financialization, draws connections between growing investor interest in farmland and the increasing power and prominence of the financial sector more generally since around the 1970s, 1980s. The financialization of the US economy is a huge scholarly literature on it. It's very complicated, has many aspects to it, many facets. But these include the deregulation of the financial sector since the 70s, 80s, the growing prevalence of shareholder value as a primary principle for corporate management, the explosion of financial sector profits. Financialization also includes increasingly a centering of financial profits as a primary form of income generation for non-financial companies. So even regular companies that have historically made their money by producing commodities are now increasingly also making money from things like interest payments or from capital gains on investments. And also just regular individuals. There's a lot of work on the financialization of everyday life. Regular individuals increasingly find their ability to take a vacation or retire tethered to the performance of the stock market and are spending increasing amounts of time sort of managing their own financial lives. In addition to this work, putting it in the context of financialization, other scholars such as Brett Christophers place this trend in the context of even broader economic shifts since the 1970s towards what Christophers terms rentier capitalism, in which economic activity in general across economic sectors increasingly centers around ownership and control of scarce assets that produce revenue. So economic activity becomes less about making commodities and more about owning assets, whether those assets are financial securities or patents or mining concessions or something like farmland. And I think this is probably obvious to all of you, but I think this is really important to study for a couple of reasons. One, the really probably very obvious one to all of you, is that this trend has potential, this growing financial investment in land, this assetization, this treatment of land as a regular asset class like any other, could potentially further the ongoing consolidation of land ownership in the US and elsewhere. Smaller and less well-resourced farmers, historically underrepresented farmers, young and beginning farmers are going to struggle to compete in land markets when they're bidding against really deep-pocketed financial institutions with tens of millions or even billions of dollars to put towards farmland. Also, just on a more abstract philosophical level, going back to this overall trend of financialization, I think that this really matters because of how it can feed the growing economic inequality already associated with financialization. So the French economist Thomas Piketty has very famously argued in Capital in the 21st Century that a prominent reason for growing inequality in the US and elsewhere is that the returns to wealth have been increasing relative to returns to labor. So basically, those who make money simply because they already have money are winning out over those who make money by working. As farmland becomes a financial asset, as we see this assetization process unfolding, it increasingly feeds this loop of wealth accumulating for the already wealthy. And farmland becomes, as property that can generate wealth, becomes increasingly an accessible means to achieve this ever-growing wealth and widening inequality. So the rest of the presentation, now I've sort of gotten that theoretical bit out of the way. First, I'm going to just talk about what I see as kind of dimensions of how farmland financialization is unfolding. And then I'm going to talk about a couple of challenges to studying farmland financialization to even understand what's going on here. And I'm going to illustrate those through reference to a couple of case studies that I know a little bit about. Okay, so one dimension of the financialization of farmland is just, this is probably the most obvious one, is just increased investment in land. There is just more money flowing into land. Importantly, we don't actually know how much investment capital is flowing into land. One decent source of information about this, there's not a single place that we can look to find out, how much financial capital either of wealthy individuals or of institutional investors is in land. But one place we can look is the National Council of Real Estate Investment Fiduciaries, NCREIF Farmland Index. This is a body of data that's been compiled since the early 1990s. And mostly the point of this is that people can subscribe to this and find out how farmland is performing, how it's performing in different regions, returns from rent, returns from appreciation, etc., how it's performing for different kinds of crops. But it's also interesting to look at for just the way that the number of properties in this index have grown, because this index is composed of institutionally owned and managed properties. Presently, there are 6 entities that contributed to it: PGAM, formerly Prudential, Manulife Investment Management, which used to be Hancock, Nuveen Natural Capital, which is TIAA's asset manager, UBS Farmland Investors, US Agriculture, all of these used to be something else, and Gladstone Land Corporation, which I'll say more about in a minute. And it's just interesting to see how the exact contributors change over time. So it's not a perfect proxy for anything, but it's sort of, it gives a sense of how financial institution interest in US farmland has changed over time. You can see that that prior to sort of 2005-ish, there were fewer than 100 properties they were getting data on from these financial institutions that contribute data to their index, worth, only $1 billion or so. And by 2018, this is a figure from my book, and I only had data up through 2018, there were 800 properties in their index, worth about $8 billion. And as of, I haven't paid for the data recently, so I couldn't update my figure, but as of 2024, I looked it up, and the second quarter of 2024, there were 1,000 properties in their index worth about 16 billion. So we see this really huge kind of rapid increase in even just the amount of farmland and the value of farmland that's owned by these 6 entities. So this is sort of just, it's kind of a snapshot of what's going on. It's a small group, but we see a really rapid increase in investment. A second thing that we might think about, a second dimension of the financialization of farmland, is new investment vehicles being created. So the farmland investment entities, sort of asset management companies, a handful have existed since late 80s, 90s. However, it was really post-2008, we see an explosion of new farmland investment funds emerging. A couple of things that I think are really notable in this realm of new investment vehicles has been the emergence of publicly traded farmland real estate investment trusts, or REITs. REITs are a way of investing in real estate that has existed since the 1960s, and basically they're a corporate structure that pools the capital from many investors in order to buy real estate, and investors then receive dividends based on rental payments and land sales from that real estate. And it has certain advantages. It is exempt from corporate income taxes, provided they pay out 90% of their earnings in dividends. So it's been around for a while, but it was only in 2013 that we see the first publicly listed farmland REIT emerge, which is Gladstone Land. And that was followed closely, I think, in 2014 by another one called Farmland Partners, which we can see here. And I think these public farmland REITs are really interesting because they make it a lot easier to invest in farmland. Farmland has historically been quite challenging to treat as an investment object. It's relatively illiquid, and land markets have tended to be pretty local. A lot of land just never even hits the market because it just sold, to a relative or neighbor. But in this form, we see farmland transformed into a liquid asset that can be bought and sold almost instantaneously. We also see this is also significant because it reduces the upfront cost of buying land. So now anyone who can afford to buy stocks, which granted is only like half the population of America, can invest in farmland for far less than it would cost them to buy an acre of land. So this really makes it so that potentially a lot more capital can flow into farmland. This is just a screenshot of performance of these two as of today. And I think it's interesting because you just see, I mean, it looks like any other stock, right? This is liquid land, basically. Gladstone Land being the first to list on NASDAQ, even nabbed the ticker symbol land. So you can literally buy shares in land. A slightly different, but also I think really interesting new group of investment vehicles are these crowdfunding platforms, which they emerged a bit more. I think maybe the first was 2015, but many of them have emerged kind of 2017, 2018, and later. And they're all a bit different from each other, but they have their roots in the 2012 Jobs Act, which made it possible to do sort of investment crowdfunding where you're basically selling equity online. And they're all different than each other, but I think possibly all of them or most of them are only available to accredited investors. So they're seen as a slightly riskier investment that you have to have $1 million or these other requirements to be judged an accredited investor who's allowed to take on these riskier investments. And they have these different farmland investment opportunities that are posted online. So you can go to AcreTrader and be like, oh, I could buy into this Missouri farm. The minimum share is $15,000. And you can just, in a few clicks, buy a share in this farm. They have different terms. They have different minimum investments. They have different rules surrounding them. But they make it, again, a lot easier to buy farmland. I was on an airplane the other day sitting next to a retired hedge fund manager, retired at like 40. And I mentioned that I was going to a conference and he asked what I study and I was telling him about it. And he was like, oh, they've made it really easy to invest in farmland these days. I've done it online. A third dimension that I think is important of the financialization of land is changing discourses around land. So sort of, I think a really important part of the assetization process has just been a cultural shift in the way that we think about and discuss the use of farmland as a financial asset. In the US, the idea of investing pension fund money into farmland actually originally emerged in the late 1970s, which was the last time when there was, really massive run up in farmland prices, as I'm sure you all know. In 1977, as farmland values were rising to these really dizzying heights, representatives of Merrill Lynch and a Chicago bank proposed a new fund called Ag Land Trust, which would invest pension fund capital into farmland, cornering some of the profit from this really dramatic land value appreciation that was going on at the time. This proposed fund, which was at the time very, very novel, this is a New York Times article about it, was a complete failure. The moral outrage about this proposal was such that a subcommittee of the House Committee on Agriculture held 3 days of hearings about it, at which almost 50 people spoke, almost none of whom, other than the fund representatives themselves, had anything good to say about the idea. In fact, I always say that this 400-page report that came out of this hearing is actually really refreshing to read in this day and age because it's so incredibly bipartisan. You have Republicans and Democrats alike just completely slamming this idea. And the sort of underlying thread of their comments that again, across the parties, is that it would essentially be morally wrong to allow pension funds to buy up farmland, possibly driving up land prices for farmers in the process. Their comments in these hearings reveal a shared belief about the appropriate scope for financial activity in agriculture. The role of finance, many of them say, is to supply capital to producers. It's to make loans to farmers, not to monopolize scarce productive assets themselves by actually buying the land. In their response, the founders of Ag Land Trust, the representatives, attempted to defend themselves by reframing their land purchase as effectively equivalent to loaning money to farmers. So they argued that by removing the expensive burden of land ownership from farmers, they would in effect be freeing up working capital that the farmers could then use to expand their operations and profits. This did not go over well at all. For instance, one Republican representative responded to this by saying, "There's nothing that lies so deep within the soul of a farmer as the desire to own his own land. I think that's really the crux of the matter and is why such an outpouring of sentiment has occurred. My suggestion would be that you go back to the drawing board and drop the idea. You really have been tinkering with the virtue of country America with this proposal." And they did. I think 3 days later, they gave up on the idea. They dropped it. And a similar thing happened a couple of years later. Another proposal emerged, and again, hearings were held. Again, there was an outcry. And what has been really striking in studying this financialization of land is just how much this kind of sentiment, this cultural sentiment, has shifted in the 40 or so years that followed. The kind of argument that the founders of Ag Land Trust were making back then is still, I still hear that a lot from investors. I still see it in their promotional materials. But now it goes largely uncontested. So for instance, this is a report from Nuveen, the TIAA asset management company, titled Institutional Farmland Ownership, Facilitating the Separation of Farming Operations from the Capital Base. And they say the capital assets needed to operate a modern commercial farm can be considerable. And as a result, farming operators have determined it increasingly less essential to have complete ownership of their capital assets. So in other words, farmers don't really want to own land anymore. They'd rather be really big, have really big operations on rented land. And you see this a lot also around arguments around retiring farmers. So there's the sort of mantra that all of this land is going to change. What is it? 60% of land or something is going to change, 70% change hands in the next 20 years. And that the next generation isn't particularly interested in owning land. And therefore, to keep it in production, institutional investors are kind of doing this service by stepping in and owning it to ensure that we continue to feed the world, et cetera. So these really, really different discourses that are at least very common within the investment community and relatively accepted there. And I think seemingly much more accepted by policymakers. In terms of, I said I would talk about a couple of challenges to studying farmland financialization. For me, the number one challenge is a lack of data on land ownership. I think probably, again, this will be no surprise to anyone listening to this talk. Parcel data, when you want to know, who actually owns a property, you can get it, but it's usually at the county level through the tax assessors, in which case the way that you access is totally different. Sometimes it's free, sometimes it's like $1,500. It's always different, or you can get it through commercial vendors like Regrid. But again, you have to have a bunch of money. If you want to look at, say, a whole state, you have to have a ton of money to do this. This isn't something that's just accessible to anyone who wants to know who owns the land around their home or their farm. And then once you have the parcel data, once you get these CSV files, this geospatial data, use of subsidiaries to buy land makes it really challenging to determine who the actual ultimate owner of land is. I just put this picture here. This is when I went to the County of Santa Cruz assessor's office today. I just noticed that I haven't really looked at a lot of parcel data for California specifically. And so I hadn't realized this. The California State Government Code Section 6254.21 prohibits the assessor from providing ownership information via the internet. And when I looked it up, this is a law about not providing home addresses and telephone numbers and things of elected officials. So that's really interesting, if that's widely used as a reason not to supply more information about who owns land. this has come up for me in a project I've been doing with a graduate student, Elsa Calderon, in collaboration with the National Family Farms Coalition in the Mississippi Delta. They had in 2019, there was this great Atlantic article written by Van Newkirk, a journalist, about how institutional investors, including TIAA, were increasingly moving into the Mississippi Delta, and that this is a place where there's been a lot of dispossession of Black farmers. And the National Family Farms Coalition and their member organization, the Federation of Southern Cooperatives, wanted to know a bit more about what was going on here. So Elsa and I have been looking at parcel data, and she's been interviewing farmers down there. And it is so difficult to really find out who owns the land. These are some sort of tentative maps we've made along the way of a couple of counties. We've just been mostly looking at 6 counties. And in order to get even, we're hoping to have much better maps soon. We're still in the middle of this process. But in order to get even this kind of level of maps where you can identify the land owned by specific kind of the end investors behind, or the asset management companies behind these entities, you have to do so much merging of data. I often see, you know, the scholars who work with geospatial data are often looking across broad geographic expanses. They merge property owner names that are very similar to each other, because, you know, a lot of times like one will be LLC and the other will just be LL and they forgot the C, but they can't merge companies with completely different names. And in this process, so we created a whole workflow for going through this data, basically having multiple undergraduates sifting through this data, comparing information in the parcel data, things like COs, you know, care of in an address, the actual mailing addresses of the behind for the parcel data, which is often the mailing address of the parent company or the asset management company behind it, comparing that to information on the Mississippi Secretary of State website, doing a whole lot of complicated cross-checking with Google. And we find all sorts of really interesting things. We find that, I mean, for instance, these are just a few really basic examples. There are many more examples. Some of these really big investors own land under lots and lots of different names, tons of different LLCs, or manage land under these different names. Sometimes they're easy to figure out, like Acre Trader seems to call their companies by like Acre Trader 141, Acre Trader 130, so easy naming conventions. Some of them, like there's one, Homestead Capital, that we realized after a while we were seeing all these farms with names like Maroon Alpha, Maroon Delta, Maroon Charlie, and after a while we're pretty certain it's Homestead Capital based on our sleuthing. But others are really hard to figure out. The names are just totally different from each other, and you just have to figure them out one by one through really intense research. So it means that you're almost always going to have underestimates of the extent of farmland consolidation, and it effectively really obscures this financialization of land, makes it really difficult to study. So I think that's a big issue. Another big challenge is investor greenwashing. A lot to say about this, but investors, I think this kind of relates to some of the discourse stuff I was talking about earlier. Investors frequently frame their farmland acquisitions as contributing to sustainability. And I think that in this moment where environmental and social governance, ESG investing is very accepted, where regenerative is kind of increasingly popular with corporate actors as a way to potentially frame the act of owning and managing land, depending on the regenerative standard. Obviously, some are very stringent. The act of owning and managing land itself as like countering climate change. We see a lot of potential for greenwashing of these investments, sometimes aided through programs such as Leading Harvest, which is a certification that was essentially created by several, I think 13 of these large corporate entities, which included basically all or most of those actors that contribute to NECREIF, these really big institutional owners of farmland of farmland assets in the US. And a case I think that's useful for thinking about this is California's Cuyama Valley. This is a critically overdrafted water basin. You can see it here. on the California Department of Water Resources map of critically overdrafted basins. And in, I want to say 2015, just after SIGMA went into effect, there was a large land purchase there. I think it was 8,000 acres. And this was purchased by a company that was the main investor for which was Harvard Management Company, which is manages the endowment of Harvard University. And they pretty much instantly began converting 1,000 acres or close to it into an irrigated vineyard. This was dry rangeland. And again, this is like as SIGMA has just gone into effect at the height of a drought in a valley that gets just a few inches of rainwater each year, where groundwater is being pumped out way faster than the rate of recharge already. They drilled some wells, began creating a vineyard on a chunk of this property. And here you can see in a Wall Street Journal article, some of the vineyard. And the neighbors were a lot of the neighbors were really up in arms about it, really worried about how these big wells were going to affect their ability to use their own wells, whether their wells were going to run dry. Also just really concerned about the sustainability implications of this in general. The investor, the sort of asset management company that ran the LLC that owned the land, again, multiple layers of ownership, became really involved in the SIGMA process. Sustainable Groundwater Management Act, Sustainable Groundwater Planning Process, the GSA. They first were behind a proposal to actually split the basin so that they would no longer have been in the part of the basin where some really big organic carrot growers pumped a lot. When that failed, they got really involved in sort of gathering and contributing their own data to the consultants who were helping create, had been hired to help create the groundwater plan, and were successful in some cases in actually influencing them to allow for lower drawdown levels in the management region where the Harvard Vineyard was based. They really got, very involved in making sure that they would be able to extract as much groundwater as possible from this critically overdrafted basin. And all the time, this is what their website looks like. You go to the Harvard Management Company website, you click on sustainable investing, and you learn that they care a lot about environmental and social governance, that they work to combat climate change. Partway through this process, I've forgotten which year this occurred in, 2020 or thereabouts, Harvard actually announced that it was divesting its portfolio from fossil fuels. So you see at the end, they say it's extended its efforts to combat climate change to include its endowment portfolio, which is committed to achieving net zero greenhouse gas emissions. And yet, most recently, the most recent development in this Cuyama Valley saga is that they're drilling a test well. They're allowing I think, Michigan-based company to drill a test well to find out if there are any fossil fuels under their property in the Cuyama Valley. So I think that somehow it seems to be very easy to assert sustainability while acting in ways that would not meet any common sense definition of sustainability. So to conclude, farmland is increasingly being treated as a financial asset class. In many ways, this process is still in its early stages. This has only been going on for about 15 years. The amount of land owned by investors, although it's growing rapidly, is still not a huge amount of land. It's still really a drop in the bucket of US farmland. But I believe it's still really crucial to monitor because of how it could contribute to ongoing dispossession and farm consolidation in the US. And this is made more challenging by lack of clear data, and also by misleading investor narratives. Thank you very much.
Thank you so much, Madeleine. A lot there to think through. So we do have time here for questions for Madeleine. So you're welcome to either post a question into the chat or feel free to raise your hand and we can assist you to unmute if you'd like to ask a question directly. Give people a little time to think through the questions they may have. A lot there to think about. I suppose as people are coming up with what they might like to follow up on with you, Madeline, I'm thinking about, and I know this is a bit of an unfair question, but I'll ask it. And of course, to the extent you feel comfortable answering it, just what kinds of tracking mechanisms or regulatory structures could possibly be in place that would make some of the challenges that you've identified here um I don't know, less challenging, right? In terms of understanding, tracking, monitoring, understanding the patterns that you've described.
Yeah, I don't totally know, to be honest. I think, I mean, and I don't want to minimize the importance of privacy, for instance. I think a lot of people, not just policymakers, but a lot of people wouldn't want their land ownership information on the internet. Um, However, I think that, I mean, one thing, even if it was just reducing the financial barriers to accessing parcel data. So even if, just saying all parcel data um, can be, I don't know. I mean, but it doesn't really seem fair to me either that I can get parcel data with names in it and addresses for free, or, to work with just by paying money for it. That seems, it's basically saying that there's if you have the money, you're welcome to it. Privacy, the privacy barrier is only there for, the riffraff who can't afford to pay.
Yeah.
So yeah, I mean, I think from a, I think that overall, if a way could be found to actually just have property data, parcel data for all of California available and searchable for anyone for free, I think that would be absolutely incredible. I don't know what laws would have to change to make that possible.
Mm.
But that would certainly make my job a lot easier. And I think that it would create a lot more awareness. I think just the absence of that data is playing a big role in obfuscating consolidation of land.
Mm.
I
Thank
don't
you.
know. I don't know what would then happen. Who's going to do the work to find out who actually owns these companies? Like maybe companies have to disclose, the ultimate owner or manager of properties as
Yeah.
well. But
That
that
was
would
going
be
to
a
be
big
my next,
change.
that was going to be my follow-up question
Yeah.
to you is, given the experience you've had in the Mississippi Delta, it seems like that's the next layer of what would have to change, would be ways
Yeah.
of making public the various subsidiaries that actually
Yeah.
are. Is that true? Would you say that's another
Yeah, I mean,
piece
not
of that?
most people don't have an army of eager undergraduates who are willing to spend hours a week searching the Mississippi, Secretary of State website and Googling corporate addresses.
Yeah.
Um, so yeah, I mean, it's just a huge barrier to information.
Mm. Thank you.
But I don't know. I don't have the perfect example to point to of like this place does it right.
Right. No, like case study
Yeah.
solution there. Okay. Well, thank you for sharing that. Do others have questions or thoughts or maybe just things that resonate with you that you'd like to share here or discuss? It's a relatively small group today, so anyone who does feel like you have something to share or an idea, I think we'd all would very much welcome to hear from you.
We have a Q&A question asking, have you seen instances of assets that have been offloaded from portfolios? And if so, have there been reasons for that?
Hmm. Yes, definitely. I mean, there are a lot of sales actually between these investors. So you'll be like, oh, TIAA just picked up a bunch more land. Oh, they bought it from this Canadian pension fund or something. I mean, part of it is just asset management strategies. Companies just have natural resources takes on a bigger or smaller role in their portfolios depending on sort of who's taken over and what strategies they embrace. These strategies haven't all been totally successful. I think think of a good example to give you. I mean, Harvard itself has gotten a lot of pushback around some of its investments. It has had and including the Cuyama Valley, but also including, for instance, Brazilian investments that it turned out, were acquired had a really dicey history of dispossession before their acquisition. And, Harvard got a lot of blowback for not sufficiently investigating that, not doing due diligence around the injustices associated with those properties. So yeah, I mean, I think that definitely not all of these investors have found this to be a totally successful strategy for them. But I wouldn't say there's like a massive trend in that direction or anything.
Thank you for that. And we have a question from Liliana about whether this will be made available, whether this is recorded, so you can share with other team members. Yes, all of our speaker series presentations are recorded and they go onto the Strategic Growth Council's YouTube page. So you will be able to share out what you learned today. And then, of course, Madeleine has a few publications as well as her book if you'd like to dive even deeper. Thanks for that.
The book is open access, so it's free. So you
Important point.
Download that. Download a PDF of it. Really cheap birthday presents.
I was thinking, just in relation to what you were just saying in the question about disinvestment, right, in these properties. And Caleb and I recently had a conversation with someone who was discussing the big drop in farmland values where she was in California. And we were talking, and she sort of mentioned that investors are interested in this in an investment as an investment tool, as long as it is a valuable investment tool.
Yeah.
And when they no longer are, there's a real concern that it could lead again to a lot of loss of farms in terms of the crashing of that farmland market. So I don't know if you have heard people, if in your conversations with financial asset managers, things like that, if you hear discourse about that, or if really they're more focused on the gains at this point.
Well, it's tricky because when you're, they always just want to tell you about what a great investment is if it's an investment that they're selling.
They're not talking about
but yeah, there are really interesting ways. I mean, one thing, I don't know if I have a specific, was it because of Sigma or?
I think that it was the crash in wine grape and the crash of the wine grape values. So that was producing those wine grapes was being torn, those grape vines were being torn out. And so land was coming very cheap
really
in those areas. Yeah.
Yeah. Oh, that's super interesting. No, I haven't heard too much. I don't know too much about that. I think one thing that really interests me, this is sort of a slight tangent, but is the extent to which the different ways in which efforts at land valuation, different investment entities have different strategies for how they're going to, or different investment theses around why they think their land is going to go up in value. And I think consistently one finding that I've had in my research is that the land appreciation itself is a huge part of the motivation for buying these properties, right? Like the rental income, or sometimes they just produce on the land directly, the production income, but usually rental income from leasing out the properties is a big part of the motivation. But the actual land appreciating over time is a huge reason to buy land. You wouldn't do it otherwise for the most part. And so they all have sort of reasons for why buying land in this particular place or in this particular type of crop is going to appreciate and produce capital gains that way. And I think it's interesting to see how the sort of different strategies work. Like some of them, and particularly in the realm of there's sort of the emergence of these impact investment funds. So some of them, like Farmland LP, is a California fund that positions itself very sustainable, particularly because it actually requires a transition to organic production on the land that it farms or that it leases out. And so that, organic land is higher valued than non-certified organic land. And so they're literally that's part of their way that they're causing the land to go up in value is by getting farmers to bring it through the certification process. But I think, but a lot of times the type of way that the land is used, that in order to produce land valorization actually is kind of not as sustainable. Like the best, you know, a really obvious way that you can cause your land to go up in value is just to produce way more intensively on it, by, you know, so you increase your yields, therefore the land's going to go up in value. So yeah, that was actually not very related to what you said at all, but
That was really
I think there are a lot
interesting.
of very interesting different strategies around ensuring that land does go up in value and not down. Well, obviously sometimes it does go down.
Yeah.
It's
I think
still
that,
you know, it's still a speculation, even though I think even though you're using the land productively or leasing it out to someone who's using it productively, the centrality of the capital gains from appreciation means that there's still, you know, there's still risk there. Things can go wrong.
really appreciate that. Land appreciation has been something that the task force members have brought up. And not to put any of our task force members on the spot. If anyone didn't have any thoughts or questions about that, it feels like this is something the task force has been thinking about in relation to land access, equitable land access in particular. Are there any other questions or comments from any members of the group here today? Oh, Leah, go ahead. I think you might be able to unmute. Oh, here we go. I will allow you to talk. There you are. You should be able to unmute.
Oh, you know what? This is someone else from FarmLink. This is
Oh,
Melissa.
hi, Melissa. Well, you are also unmuted. Go right ahead.
I was like, oh, good, Leah's gonna say something first.
Oh, no.
Um,
Apologies.
Interesting. I wonder why my name is coming up like that. Anyway, my name is Melissa Gordon, and I work with California FarmLink too. And I'm on the educational programs team, but I'm really interested in equitable land access and did like my grad school thesis work on it. And totally fine if you don't have something to add about this, because sometimes it can be frustrating when you give a whole presentation on your expertise and then someone in the audience has like a sliver of tangentially related thing, and that's the only thing that I ask about. But anyway, I was just curious if you've looked at anything explicitly race related when it comes to this land access, all the issues you talked about with data inavailability are like true and even like compounded when you're in my experience when I've looked at um, publicly available records about land ownership. I've run into things like, because of privacy reasons, you know, if fewer than 10 producers of a certain race own land in a county, then it's de-identified. And so it can
Oh,
be,
interesting.
yeah. And I put in like a request to, this was before the most current ag census, but a request, and it resulted in like 98 or something, over 90% of counties being de-identified, meaning that that many counties had fewer than
Wait, the entire county is de-identified if there's
for
one small racial minority present?
no, just about the
Oh,
racial group
okay.
I was looking for. Yeah. Which
Got it.
indicates that like farmers or producers of that race, there's fewer than 10 in like 98% of counties. I was looking at Black farmers.
Right.
Anyway,
Yeah.
I was just curious
Ooh.
if you had looked into anything um related, yeah, to like in terms of equitable land access or ownership, or who's unable even more to buy land when it's been invested, or is there anything surprising? Is it like actually coincidentally some investors are racial minorities and now are landowners in these ways or something? I don't know.
Mm-hmm.
Yeah.
Yeah. I mean, I don't know about the data thing that you're describing, and I actually really would like to follow up about that. I think that's really interesting. I think so. The research that I've been doing in the Mississippi Delta with my graduate student and National Family Farms Coalition has been interesting in that regard. So we haven't been thinking so much about intersections of data and race, but we initially were doing that research because sort of the question that had emerged for National Family Farms Coalition out of their conversations with the Federation of Southern Cooperatives was basically, are these large institutional investors such as TIAA taking advantage of the particular legal vulnerabilities faced by Black farmers, such as heirs property, you know, linked to heirs property ownership. And it's been really interesting. My graduate advisee, Elsa Calderon, has spent a couple of summers in the Delta interviewing Black farmers and landowners around their experiences with these kind of big investors coming in and buying land. And initially, the first summer she was there, we hadn't gotten the parcel data yet. And she was just interviewing people and saying, you know, what do you know about like TIAA buying land or these other entities buying land? And they were all like, oh, nothing. Like they didn't know anything about it, really. It wasn't common knowledge. It was not something anyone knew about for the most part. And we actually began to think that, oh, maybe this is not really happening. Maybe it's just this, like, this particular county that this, you know, article was reporting on. Maybe it's just not really happening very much. And then we got parcel data, and I mean, to me, it's pretty huge, the extent of financial land ownership in this region and the number of investors that are involved, the number of different LLCs that they're buying land through. And so, I mean, we certainly found a large amount of concern around dispossession, of like fear of having elites, you know, basically conspire to steal land, of people being afraid of, you know, people making payments on their land in order to get adverse possession, of people, you know, people showed us letters that they'd gotten from investment companies saying, you know, don't you want fast cash to pay off your debts rather than this land, you know, very like clearly targeting heirs property owners. But those big investors, those big kind of financial entities, I mean, the result, we're still kind of in the middle of doing this research. I think it may become her dissertation, but the answer seems to be like, no, they're not really using those kind of strategies. Those are much more smaller, like local folks, or sort of in smaller investment companies and developers. And it really seems to be almost like a two-tiered, you know, land market, where you have these smaller Black farmers who are often really like struggling to hold on to their land. And then you have the Bill Gateses and the TIAAs of the world buying these huge, formerly corporate owned or elite owned, you know, massive properties that they're just operating. They're not like coming in and doing all this work to get, you know, to force a sale of a small heirs owned farm. So I think for us, that was really interesting, is just realizing kind of how different, you know, it's almost like these institutional investors are like inheriting the legacy of the plantation much more than working to dispossess small farmers. But nonetheless, you know, those who were in the know were kind of expressed that like land values are going up a lot and rents are going up a lot. And it's not that they're not being affected by it. It's that there's very little transparency and they're sort of operating in different realms of the land market.
Thanks for that, Madeline. A quick follow-up to that. Is that true also of these other like Acre Trader and those, are they also at that, you know, Bill Gates level, or are they somewhere in between?
They're buying much smaller properties.
Smaller.
Yeah, in fact, so I don't know. We haven't found anything out about specifically what techniques they're using or anything like that. That's a great question. Because we actually, the way that we were sorting our data in order to be able to do this really intense searching process to try to figure out who the ultimate landowners were, we first just got rid of properties under, I think it was 10 acres. And we were like, no investor owns properties smaller than 10 acres. And then I think there was one Acre Trader property that actually we did end up getting rid of because of that. So I do, you know, they do sometimes buy these smaller properties. So yeah, that's a really great question.
We have just a couple of minutes left. Is there anyone else who would like to ask anything here?
We have another Q&A question asking, have you seen particular landowners or types of land tenure that have better weathered institutional investor predation?
I don't know if I totally understand the question. I mean, let me think. I mean, because I think predation kind of implies that that there is this sort of, active effort at dispossession going on, when I think that the bigger issue is just the absolutely colossal amounts of money involved, and that just make it so that, some of the, like TIAA has over $1 trillion. Just the amounts of money that these investors, these large institutional investors, are putting towards land, like even if a very small amount of their portfolio is allocated to farmland investing, that's often a massive amount of money from the perspective of any individual farmer, right? And so I think the issue is much less like any kind of anything targeted, and much more just the massive inequality in I can't even visualize these amounts of money. There's $1 trillion has no meaning to me, basically, other than being I know it's a really big number. So I think, to me, it's more these kind of structural issues of just how much money has accumulated in the financial sector and is now looking for outlets, including these diversification benefits that come from farmland investing, this inflation hedging that comes from farmland investing, and is now that sort of floodgate has opened and that money is flowing into farmland. So I think, it's kind of all the normal stuff that can protect make any farmer more secure, like actually, if you're not indebted, because actually owning land outright. But I don't think there's anything sort of particular that would protect you against the threat of this sort of more structural looming inequality.
Well, thank you so much for taking this time to talk with us, to present to us, and then answering all of those questions. We really appreciate it. And thank you to everyone who attended. Please do follow along with the work of the task force. Please do check out the video, which will go up in the next day or two. And please look more into Madeleine's research if you're interested to learn more. Thank you all very much.
Thank you all. Thank you for the work you're doing.
Thank you. Bye.